Exactly 37.8% of the current quarter distribution from Mapletree Logistics Trust is a return of your own capital, not organic cash flow. If you rely on this asset to fund your supplemental retirement scheme withdrawals, your underlying principal is bleeding out to maintain an optical payout. This forensic audit strips away the management narrative of operational stability to expose the severe structural leaks threatening your dividend. I have been watching this one for a while, and the number that finally made me sit up was the gearing figure. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. When we see that 37.8% of the distribution is a return of capital, we have to call it what it is: principal bleeding. This is not organic cash flow generated from the warehouses or the tenants. It is an optical payout maintained by selling off your underlying capital just to keep the headline yield looking attractive. My audit today strips away that management narrative of regional strength and operational stability. We are here to expose the structural leaks that are actively threatening your dividend and your retirement peace of mind. Mapletree Logistics Trust has been sitting in the portfolios of retiring Singaporeans for years, not because it was exciting, but because it felt reliable. It was a logistics landlord with Asian reach and a name you could explain to your spouse over dinner without needing a whiteboard. But being easy to explain does not make it easy to forensically audit. Turning to the cold hard cash, the total distribution per unit for the fourth quarter contracted by 7.0% year-on-year to 1.819 cents. This is the actual money deposited into your bank account, and it falls sharply against the historical benchmark. In the prior financial year, the full year payout stood at 8.053 cents. For peer context, Capital and Ascendas REIT experienced a mere 1.3% decline. While Capital and Ascendas passes the income stability test, Mapletree Logistics Trust fails it completely. If regional currencies depreciate another 10%, a $50,000 holding would lose $324 in annual income. Think of this using Kopitiam logic. If your favorite stall raises prices, but gives you a smaller portion of chicken, you are paying more for less. Here, management is giving you a smaller portion of cash, while the underlying chicken, your capital, is being sold off to pay for the plate. We see this in the fourth quarter figures where divestment gains of 7.709 million Singapore dollars were needed just to prop up the payout. Management claims a 0.9% increase in operational DPU, but the reality is that your total bank deposit is shrinking. The debt wall is our next major concern as aggregate leverage has climbed to 40.6%. Gearing is simply how much of the property portfolio is bought with borrowed money, and this figure sits uncomfortably above the historical average. Against our peer context, Capital and Ascendas REIT maintains a much safer gearing of 39.0%. Mapletree Logistics Trust has breached our strict 35% forensic ceiling. In a recession scenario with a 10% property devaluation, gearing would spike above 45%, likely triggering a deeply discounted equity fundraising where you must inject fresh capital or suffer permanent dilution. Looking closer at the debt profile, we see significant currency risk. Japanese yen debt makes up 26% and Chinese yuan debt makes up 23%. These are volatile currencies, which means your gearing is at the mercy of exchange rates, not just interest rates. The average debt duration is 3.6 years, but the maturity cliff is steep. We are looking at a cumulative 43% of the balance sheet that must be refinanced in a high-rate environment. That 2-year window runs from financial year 28 to 29 through to financial year 29 to 30. The interest coverage ratio has now compressed to a dangerous 2.9 times. This ratio tells us how many times the rental income can pay the bank interest, and management previously maintained this well above 4.0 times. In peer context, Capital and Ascendas REIT boasts a coverage ratio of 4.3 times, passing the fortress standard. Mapletree Logistics Trust fails this critical debt safety check. A 10% rate hike would crush this further to 2.6 times. When coverage falls below 3 times, the bank gets paid before you do, making your dividend vulnerable to suspension. The China portfolio is currently a massive drag on performance. Rent reversion measures whether new leases are signed at higher or lower rates, and the China portfolio delivered a negative 2.0% reversion. While this is an improvement from the negative 9.4% seen a year ago, it is still a loss of income. Singapore assets are seeing positive reversions of 5.8%, but Singapore is only 20.8% of the assets under management. The regional weakness is simply too large for the local strength to offset, creating a sustained drag on your dividend growth. We also have to talk about the hidden cash drain from tax provisions. Income tax for the quarter spiked violently to 54.48 million Singapore dollars, up from 9.88 million Singapore dollars in the prior period. This represents a massive spike that drains cash that should have been distributed to unit holders. While property expenses actually fell 6.3% to 25.132 million Singapore dollars, the tax bill wiped out every cent of those savings. The taxman does not care about management's narrative of operational efficiency. He only cares about the bill. Management spent almost no time addressing the severe internal auditing failure regarding the statutory exchange filing. Inverting the financial columns for the fourth quarter is not a minor administrative slip. It points to structural fatigue in the compliance layer. When a multi-billion-dollar entity cannot align its statutory profit and loss statements correctly, it forces us to question the rigor applied to property valuations and currency hedging calculations. Silence on compliance failures is the loudest warning sign for forensic auditors. The numbers do not lie, but the people typing them occasionally do. Watch the hands, not the mouth. Moving to the reality check on valuation, the Investing Pro fair value sits at $1.43. The current market price is $1.22, which looks like a 14.6% discount. However, we have a massive forensic gap alert. CGS International has issued a target price of $1.68. This target diverges from the forensic fair value by a staggering 17.3%. Occupancy holding at 96.9% is good, but the valuation gap between the street and the forensic reality demands a much closer look. Think of this using fair price house brand logic. You know a carton of house brand milk is worth exactly $2.50. If a promoter tries to sell it to you for $3.50 because they printed a new label on the box, you walk away. Historically, this asset trades at a price-to-book ratio of 1.10 times, but it is currently at 0.97 times against a net asset value of $1.26. Buying at that aggressive street target of $1.68 practically guarantees a permanent capital loss for a heartland investor. We calculate the true risk premium by taking the asset yield and subtracting the risk-free rate. The current yield is 6.06% and the Singapore 6-month T-bill rate is 1.40%, giving us a risk premium of 4.66%. For this audit, I apply a conservative stress test floor of 3.2% because we audit for the storm, not the sunny day. The minimum yield hurdle is 4.7%. While the yield mathematically justifies the risk, the actual quality of that income is under heavy fire. Our income sustainability scorecard shows mixed results. The headline dividend yield of 6.06% passes against the sector benchmark of 6.02% set by CapitaLand Ascenders REIT. However, the total DPU of 1.819 cents is a 7.0% drop from the prior period, earning a fail. Net property income also failed, coming in at 151.4 million Singapore dollars, down from 152.8 million Singapore dollars. The headline is attractive, but the underlying cash flow generation is clearly weakening. We have issued a gearing alert and an ICR alert for this asset. The 40.6% leverage ratio carries structural risks that directly threaten future distributions and breaches our 35% forensic ceiling. The interest coverage ratio of 2.9 times means the buffer has eroded below acceptable sanctuary standards. These are not just numbers on a page. They are the defensive walls of your portfolio, and right now, those walls are showing significant cracks that management is trying to paint over with optimistic guidance. The debt health table confirms the failure across almost every metric. The gearing ratio of 40.6% is a fail against the 35% threshold. Net debt has grown to 5.489 billion Singapore dollars, failing the stability test. The interest coverage ratio is a fail at 2.9 times against the 4.0 times requirement. With the nearest debt maturity in financial year 26 to 27 and 716 million Singapore dollars in refinancing exposure, the gap between management commentary and the balance sheet reality is exposed. To get the full picture of debt health, we see continuous expansion from 39% to 40.6% gearing. Net debt is growing, and that 716 million Singapore dollars in required refinancing is dangerously close. This is why we perform these audits. Management might say things are stable, but the balance sheet proves that the debt load is increasing while the ability to service that debt is shrinking. For an income investor, this is the most dangerous combination possible. Before we move to the final verdict, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds, and it tells the algorithm that data-driven SGX analysis deserves to exist. Looking forward, we do not rely on hope, we rely on quantified macro triggers. Our bear case, with a 40% probability, sees debt repricing colliding with currency drags, leading to a dividend cut. Our base case suggests DPU remains flat as China reversions stay sideways, meaning your purchasing power is eroded by inflation. Even the bull case, which requires accelerated global rate cuts, only sees the distribution yield recover organically. We must map these scenarios to your CPF and supplemental retirement scheme capital to ensure you are protected. Management has unfortunately lost forensic credibility. During the previous period, they celebrated a contained cost of debt at 2.6%. Yet, the Chief Financial Officer confirmed in this earnings call an expected step up to between 2.7 and 2.8%. This is a 4 to 7% increase in the cost of capital that management failed to signal early enough. When prior guidance fails to match the mathematical outcome, the executive team loses the benefit of the doubt. Trust the balance sheet, never the spoken guidance. We must evaluate credibility strictly on the decimals. They promised a contained debt ceiling but are now actively raising the roof. Leadership celebrated stability in the prior quarter, but this call quietly guided the market toward higher interest costs for the new financial year. This is a direct contradiction of the narrative they sold to investors. Credibility is earned in decimals, not in slide designs. In this market, you have to watch the hands of management, not just listen to their mouth. While free subscribers are reading yesterday's story, Iggy's elite investors are already cross-checking the next setup together in real time. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and you start being the analyst. You get the full forensic picture before the market opens, not after it has moved. The forensic zone for Mapletree Logistics Trust is Zone 4 Caution. The portfolio composition reveals that 37.8% of the payout is artificially engineered through a return of capital, which overrides any optical safety from the headline yield. Management might highlight 300 million Singapore dollars in new green financing, but those ESG badges do not pay your bills. Rent pays your bills, and right now, rent from 18% of the portfolio is shrinking while your interest costs are rising simultaneously. This caution rating means the asset is speculative only. The 37.8% return of capital is the primary red flag, showing that the payout is not being covered by what the properties are actually earning. When you see rent shrinking in a major market like China and interest costs rising at the same time, you are in a squeeze. My forensic stance is a watchlist trigger. We are auditing for long-term survival, and right now the quality of this income is under heavy fire from multiple directions. We have to ask the hard question. Are you willing to sacrifice your principal capital just to chase a 6.06% yield that the underlying property cash flows cannot actually support? My forensic stance remains a watchlist trigger because the quality of income is being compromised to maintain appearances. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor, I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.